Hello, this is Professor Randy Minton of Thomas University, and today I'd like to go over example 5.23 in your textbook. And that example deals with a multiple step income statement, and I'll just read you the start of it. It says, on October the 31st, 2016, the balances of the accounts appearing in the ledger for Prestige Furnishing Companies, a furniture wholesaler, are as follows. And then it has two columns of listing of accounts, and then it says A, prepare a multiple step income statement for the year ended October 31st of 2016, and then item B asks us to explain the differences between multiple step and single step income statements. And I think I'll skip that part. You can look that sort of thing up in your book, but I think it's really more important that we go through and kind of decide how we would put this thing together. And as my usual want is to do, I've gone ahead and I've added some headings out there on this particular Excel spreadsheet, and now I'm going to come in and those items that I think are really important for you to understand, we're going to enter those items. At the beginning of all financial statements that are published, we have three rows that start every single one. The first is the name of the company. The second would be the name of the statement being discussed or being presented, and the last would be the date of time or the period of time that the statement covers. And in this particular case, it is for for the year ended October the 31st of 2016. So we would actually say for the year ended October 31, 2016. And that's the period of time that is covered. Now I want you to notice that in an income statement is like a motion picture. It covers an extended period of time, whereas a balance sheet is always only good for a single day. And in this case, we're talking about the income statement. Now we don't put on here that this is a multiple stage income statement. That's a given based upon the way that we present the actual income statement. All right, so now let's turn our attention to the actual problem itself, and let's walk down through these two columns and see which items actually go on the income statement and which do not. The first is accumulated depreciation building. Well, that's a contra asset, so that belongs on the balance sheet. The next is administrative expenses, and that is an expense item. All expenses will be handled on the income statement, of course, so it will go on this statement someplace. Next is the building, and a building is again an asset, belongs on the balance sheet, as does the next one, common stock or cash, and then the next one, common stock. Cost of merchandise sold, however, that goes on the income statement. You'll see where that goes here in a moment. Dividends do not go on the income statement. Interest expense, however, does, but it is considered a non-operating expense. Merchandise inventory is another balance sheet item. Notes payable, another balance sheet item, a liability. Office supplies, that's an asset, goes on the balance sheet. Retained earnings, of course, goes in the stockholders' equity section of the balance sheet. Salaries payable is another liability. Sales, of course, is an income statement item. That's your revenue stream. Selling expenses, again, expenses go on the income statement, and store supplies go on the balance sheet. Now, I think maybe they try to confuse you a little bit and kind of make you wonder if you're supposed to figure some things out because they have like salaries payable. But they don't give you enough information to make any kind of determination with that. So we have to assume that that's simply a payable. It does not affect the expense side. And the same thing is true, of course, for office supplies and those other prepaids that we would typically maybe make some adjustments to. They don't give you any information related to those adjustments, and therefore you have to just assume that those are assets. So in the case of the income statement, it always starts out with your revenue stream, and in this case the revenue stream is sales. So we would come over to the sales section. In the case of a multiple step income statement, that's going to be all the way to the far right, and it is $6,410,000. So we're going to type that in. And then the next thing that goes on this multiple statement, remember we're now in the realm of a merchandising business, so they always have a cost of goods sold, or in this case a cost of merchandise sold. So the cost of merchandise sold showing is $3,800,000. And the difference between those two numbers will be your gross profit. Now, gross profit is different than net profit. Gross profit simply the sales or the revenue minus your cost of merchandise sold. You can still have a loss even though you have a gross profit. If your expenses were high enough, you would have a loss. Now, after we've done that, we go to the operating expenses and we start out with selling expenses. And they've just given us a single number here of $715,000. But what would this be? Well, it'd be like advertising. I'm just putting these things in here so you can kind of see. Promotion, sales salaries, for instance, and maybe other things. But they didn't give us any of those details, but I just want to put them in there so I don't just turn around and type the word selling, or type the words selling expenses again. $715,000, and they don't give us any other selling expenses, so those are the total selling expenses associated with this. The next group of costs that we need to put in are administrative expenses. And when we look down, we see the second item on the page is administrative expenses, and those would be like managerial salaries, maybe purchasing salaries in the purchasing department, etc. Just to give you some idea of what kind of costs you're dealing with there. And those were put in at $540,000. Well, there aren't any other administrative expenses. There weren't any more selling expenses. So the total operating expenses, which is the combination of total selling and total administrative, is $1,255,000. Now, the way that we get to income ultimately is we take our revenue stream minus our cost of merchandise sold, getting to gross profit, subtract our operating expenses from that, and that brings us down to the income from operations. Remember, I told you that interest expense, that we actually have some interest expenses here. So if you take a look at one of these multiple stage income statements, you'll see that you have a title of a group called Other Income and Expenses. Oops. And in this case, interest expense is the only one that we have, and that amount happened to be $10,000. And I want to say that goes over in the next column. Yeah. So the total in this case of all of these is going to be the $10,000, because we don't have any others. And I'm going to go ahead and since I've changed all these others, I'm going to go ahead and put a comma separator in here and all of that sort of thing. And now I'm going to come over here, since we don't have any more of these. I'm just going to make bring this down to this number right here. So I'm just going to say that it's equal to that number, just to make it simple. And then this number minus this number will yield the net income for this particular problem. So it's equal to this number here. Whoops, this number here minus this number here. $1,345,000 will be the amount that this company is showing for income for the year ended October 31st, 2016. As always, if you have any questions regarding this problem or any other, please bring those to my attention, and I'll be happy to work through them with you. Thank you very much, and thanks for paying attention.